everyone. Thank you for joining me virtually today. I'm excited to be delivering the keynote address at the 2021 Payments Canada Summit. I'm Rob Galaski, Deputy Global Leader of Financial Services at Deloitte, and I also serve as Executive Advisor to the World Economic Forum on the future of financial services. We have some very exciting content to debut with you today, so let's get the slides up and I'll ask you to follow along with me. Today, I'm hoping to spend some time talking about the future of value transfer. But before I dive right into the trends and hypotheses we have for the future, you might be wondering, what do we mean by the future of value transfer? Why aren't we talking about the future of payments? We believe that the traditional definition of payments no longer encapsulates the accelerated changes and innovations across a wider range of types of value, stores of value, and enabling systems around the world. This means that transfer of value is no longer just about the movement of fiat money, but also the movement of digital currencies, real assets, fractions of assets, entitlements to those assets, and most importantly, the underlying transactional data. The future of value transfer looks at both the centralized and decentralized systems that could potentially coexist in the future to create very different environments, rules, and forms of government for value exchange. And lastly, our view of the future considers a world where new players performing entirely new value additive roles, for example, digital asset custodians, are an important part of the value transfer system. But before we get into the future, it's important to highlight the evolution of the value transfer system that has actually led us to this point. Our value transfer system has continuously oscillated between periods of convergence and periods of divergence throughout history. This all began with the first form of value transfer, the barter system, introduced in 9000 BC, which enabled the exchange of physical goods and services for other goods and services. The issue with barter was that it was difficult to value goods and services for an equal exchange between parties, thus leading to the first stage of convergence, the creation of gold and silver coins, which acted as the new function for trade. These coins were made of expensive materials and were not always practical to carry around. So a new type of currency was then introduced in the form of banknotes and paper finance. These banknotes eventually evolved into the fiat currency that we use today, where each country has diverged into their own form of national currency. But with the rise of the dot-com era, goods and services started being sold online, which was the beginning of electronic finance. This brings us to present day, where we are seeing the move towards digital and embedded payments. This shift is largely driven by innovations in the customer interface, new form factors, and better networks that enable more frictionless value transfer between actors. Looking at this history, it begs the question, so what's next? Through our research, we've been led to believe that the current period of divergence will not only continue, but also unfold at a much quicker rate and a larger scale than ever before. So what could this look like? One thing we know for sure is that we are entering a period where an unprecedented level of innovation is emerging in both centralized and decentralized value transfer systems, which will coexist for the foreseeable future. An interesting example is MicroStrategy, a more mature analytics and intelligence company that was an early adopter of Bitcoin. Incumbent financial institutions have taken drastically different approaches to interacting and engaging with this decentralized value transfer focused organization. On one hand, you have players like HSBC, who have tightened their trading policies to prohibit customers from buying MicroStrategy stock. On the other hand, you have banks like JP Morgan that have actually taken a 10% ownership stake in MicroStrategy. Aside from all the movement in decentralized value transfer systems, we're also seeing the centralized value transfer systems evolving faster than ever before to deliver greater value to consumers and businesses. A close-to-home example would be the quick government response in providing financial relief to those affected by the pandemic. Thanks to Payments Canada, the government-to-person payments were issued in a very short period of time, and direct financial aid was received in a matter of days. These current examples pose the question of what else is in store for value transfer moving forward, and what roles and sources of sustainable competitive advantage will emerge or disintegrate as a result. As many of you know, this space is changing quite literally by the day. It has gotten to the point where you need to read the news first thing in the morning and again before bed just to keep up with all the movement. At Deloitte, we've been actively monitoring the value transfer space in an attempt to identify the emerging trends and understand their implications to existing financial and monetary systems. I want to spend a bit of time today talking about each of these trends, some of the real examples that underpin them, and why they matter for the people in this audience. So first, and maybe obviously, while still the foundation of our financial and monetary system, fiat currencies are no longer the only available store of value. For one, central banks are exploring digital fiat currencies. And leading in this space is China, where they have already created the digital yuan and are pushing to be the first country to formally introduce a CBDC. Stablecoins, or digital currency pegged to fiat currency, will also grow in popularity as another key source of value. MakerDAO is a prime example, as the organization has created a stablecoin called the DAI that is pegged 1-to-1 to the US dollar, and by reducing volatility, allows users to exchange value with more confidence, thus resolving one of the main issues with Bitcoin and other cryptocurrencies today. There are also companies that have created their own closed loop currency systems. Starbucks is an example of such a system that exists today. Lastly, uptake in tokenization such as NFTs is enabling new forms of value storage, which brings me to our next trend. We are seeing that the traditional definition of value is expanding to include so much more than money. It now applies to new asset classes, fractions of assets, and the underlying data of different types of transactions. In today's world, one of the greatest sources of value lies in access to customer data and data portability monetization rights. In the future, the rights to access data will be increasingly distinct from the processing of the transaction. From PSD2 to consumer data right to SG Findex, empowering consumers with control over the use and sharing of their data is an irreversible trend. We're also seeing value expand to asset title ownership and rights. The digital art NFT by Beeple is a great example that used the blockchain to record ownership and validate the art's authenticity. Crypto.com is now offering an NFT marketplace that makes it easier to explore, purchase, and trade digital art and collectibles. We would also be remiss if we didn't talk about carbon credits and offsets, as the environmental externalities become a more material aspect of value change between parties. Green bonds, for example, are providing investors with a way to confidently invest in sustainability-focused projects. These green bonds can have covenant terms that are linked to specific green outcomes using smart contracts, which, if breached, requires the issuer to pay a higher coupon rate on the bond. This asset class is growing in popularity, with the World Bank issuing green bonds in 22 different currencies, totaling nearly $15 billion since 2008. And finally, the transfer of real assets is becoming more digitized and streamlined through tokenization. Atlant, for example, has created a platform built on the blockchain that allows and facilitates real estate and rental property transactions. In addition, new ways to assign asset values are emerging, especially with the rise of tokenization and automated exchanges. We've already talked about how NFTs have introduced marketplaces to assign value and trace ownership of digital collectibles. But in addition, new, more automated market exchanges are emerging that can process mass amounts of data to set real-time clearing prices. One Chronos is an example of a trading venue that allows users to code orders via APIs and then takes the auctions and returns bids in the form of combinatorial auctions. What does this actually mean? Well, let me give you an example. Imagine a foreign stock trade. Instead of having to place separate trade orders to move US currency to euros, One Chronos will set a series of conditions and a desired price. Then the software will assess multiple possibilities for each element of the trade and will only execute the trade once and only if all the conditions are met. Essentially, this allows the trades to execute more quickly as a package of code and at a better price than if each trade was executed individually. There are also ongoing movements around the improving transparency and fairness of traditional auction mechanisms and trade platforms. IEX Exchange, for example, was created with the specific mission of reducing unfair trade practices and dark pools in traditional exchanges by operating in a more transparent way. As many players attempt to monetize the value transfer system, Some of them will find themselves trying to own the network or the underlying infrastructure that helps value move from point A to point B. From our assessment, interoperability will be key to setting the winners apart from the losers in terms of network operators. Looking at Ethereum versus Bitcoin, it will be interesting to see which crypto asset will hold more future value. As it stands, Bitcoin is more focused on becoming an alternative to national currencies. However, Ethereum has expanded beyond just a store of value, but also now a decentralized platform that is able to deploy smart contracts and allow developers to build and run distributed applications. Another example on the importance of interoperability would be SWIFT, the network for cross-border payments. Recently, SWIFT explored a proof of concept using distributed ledger technology and how they could deliver real-time liquidity, transaction monitoring, and reconciliation. However, one of the key concerns with this proof of concept was around the interoperability of moving to this type of network for smaller correspondent banks who may not have the understanding nor the financial resources to invest in such a material network upgrade. Our next trend revolves around the evolving competitive dynamics within the value transfer ecosystem, shifting power disproportionately to user interfaces that were only considered the last mile previously. First of all, user interfaces are becoming the interoperable gateway for diverse value transfer systems, from traditional payments to tokenized assets. PayPal, as an example, has expanded their app to not only provide traditional checkout solutions, but now allows its users to buy, hold, and sell various crypto assets through its app in the US already. The role of user interfaces is particularly key for customer ownership in decentralized value transfer systems where value is no longer stored in accounts. In addition, user interfaces with critical scale are establishing their own value transfer systems. In this case, value is stored in the proprietary accounts and transferred and settled internally, radically optimizing the cost and speed of value transfer. Look, for example, at Alipay, which started out as a mobile wallet and has now grown to over 520 million users and 110 million partners across the 15 countries that facilitates payments in the Ant financial ecosystem. Due to its focus on integrating high touchpoint financial and financial adjacent services, such as transportation access, e-commerce, gaming, and dining, the Alipay app interface has continued to innovate and has expanded their services as a high-frequency relationship center. This transaction and ancillary data stemming from user interactions will allow front-end players to continuously innovate and expand their offerings to create sustainable advantage. Now, as many of you have experienced, modern-day form factors have evolved from brick-and-mortar terminals to the use of our mobile smartphones. Many mobile apps now enable QR code-based payments to settle transactions simply by scanning a unique code. Several companies have already created their own digital wallets, linking credit cards to complete online transactions or tap transactions without needing to take out a physical card. The scope of these form factors is expanding beyond payment information exchange to basic data sharing to further streamline shopping experiences. These connected devices are only the beginning. With the proliferation of IoT devices and 5G networking, we could have billions of connected devices all completing micro value transfers autonomously. This by no means is the end of innovation cycle for form factor technology. In fact, many technology players are already experimenting with new form factors such as voice authentication to complete transactions. All of these innovations are striking to remove any incremental instances of friction in the user experience, making it as easily as possible to transfer value and increase the ubiquity and embeddedness of value transfer in our everyday lives. And for our final trend, with all of this fast-paced innovation, you can imagine how challenging it must be for regulators to keep tabs on everything, let alone lead the way. While it's likely that regulators around the world will struggle to keep up, and as a result, create a bit of an unlevel playing field for those heavily regulated sectors, there are also new technologies that can help regulate these changing value transfer environments. Smart contracts, for instance, that are built on the blockchain could actually remove the need for traditional regulators. This technology can codify real-world, legally governed events and collect data for enforcement measures. Should all terms and conditions previously agreed upon within the set of the contract be met, the contract will be executed automatically without the need for user or third-party intervention. Though increasingly, the role of the regulator in more decentralized forms of finance is being called into question. Unlike centralized finance, value is stored in the inherent ledger of decentralized systems rather than individual institutions' accounts, making account holding entity-based regulatory regimes less effective. As a result of this shift, the traditional financial services activities such as credit provision, payments, insurance, investment management, custodial, and securities services will become increasingly the purview of a broader group of players operating in interoperable platforms and ecosystems. Now, those trends that I just talked about are really just the tip of the iceberg. But if you're feeling a bit overwhelmed by it all, we've created a framework to help us understand and organize some of the movement happening in the value transfer space. So let me walk you through it. The framework is comprised of 7 elements. First, the nature of value is the different type of assets that individuals ascribe value to, such as the new asset classes emerging that we've already discussed, like green bonds, digital content, and fractionalized real estate. The store of value is seen as the mechanism by which the value of an asset is held over time, transferring its redeemability to a future date. As mentioned, stores of value are no longer limited to cash and fiat currency with the uptake in digital currencies, tokens, etc. Next, discovery of value is the marketplace or system that helps determine an asset's value. These marketplaces are becoming increasingly automated and sophisticated, reducing friction and producing better outcomes for all. The transfer network is the underlying infrastructure that enables the movement of value from point A to point B. The form factor explores the technologies that initiate the transaction between parties. The transfer interface looks at front-end user experience, whether physical or digital, when transferring the value. And finally, rights and obligations, or the means of verifying the existence, ownership, and obligations of an asset. Digital identity, for instance, is a key enabler of digital value transfer systems where users can assert they are who they say they are when purchasing and selling assets. This framework can apply to transfers of value as simple as an in-person purchase of a coffee using cash to NFT purchases through a new digital marketplace. But more importantly, it can help us imagine plausible versions of the future and allow us to prepare for where we want to play in these future states. So now's the time for us to put this framework to the test. First, let's imagine a world where the real estate value chain takes place end-to-end using distributed ledger technologies. So what would this look like? While the nature of value would still be the same, real estate, it could be the case that it's not the entire property as the traditional model would suggest. In fact, it could be 1/50th of the property being sold, whereby the buyer in this case is entitled to 1/50th of any rental income that's earned on the property. The seller is also benefiting from improved liquidity of their asset by being able to sell and buy back fractions of the property instead of the entire asset all at once. The store of value would be a DLT-based token that represents the buyer's claim to 1/50th of the property, which would be verified and linked to their digital identity token. Due to the immutable nature of the DLT token, the buyer can access an accurate and complete view of the property's history, improving the transparency of the transaction. The transaction itself takes place on a digital network through a friendly front-end interface and without the need for costly intermediaries such as brokers, lawyers, and banks, who all typically extract some value from the transaction along the way. In this future, land registry could exist entirely autonomously on the blockchain. Once purchased, the buyer engages a digital asset custodian to safely store their key to unlocking the token. To take this even further, imagine a world where specific terms are layered into the arrangement using smart contracts, whereby the seller has to automatically purchase back 1/50th ownership stake if the property is not maintained correctly. When you think about this future, there are so many implications to our world as it exists today. First, and probably most importantly, the system becomes significantly more efficient and transparent. This is driven by improved discovery of value, as well as immutable rights and obligations associated with the token ownership. There are also regulatory repercussions, such as the need to reevaluate the process for and the amount of land transfer tax. The shift into a more automated and digitized real estate ecosystem also removes some long-standing intermediaries who seek rents from friction in the value transfer system today. These rents can then be redistributed to the end parties. This ecosystem would simultaneously introduce new players who offer value-added services, such as digital asset custodians and the property sharing and REIT sector, through tokenization and fractionalization of real estate, unlocking balance sheet equity for both consumers and businesses alike. Now, let's look at another future scenario whereby Amazon introduces its own proprietary store of value. What could this look like? Well, Amazon introduces its own digital currency, let's call it the Amazon dollar, that allows for value exchange on its platform. In the race to proliferate different digital currencies such as CBDCs, Bitcoin, etc., Amazon wins out due to its size and scale. Amazon dollar becomes a closed loop ecosystem where the company captures both sides of the wallet, both consumer and merchant, as well as merchant and supplier, i.e. Amazon businesses. As a result, any exchange of Amazon dollars does not need to go through a traditional clearing and settlement mechanism for closed loop activity. Amazon gains access to all kinds of new data about the transaction flow and financial health of their customers, while traditional players have new blind spots depending on the share of customers' wallet that's held in Amazon dollars. So what are the implications of this future? A new, more robust store of value would gain popularity, and a significant amount of the world's wealth could shift into Amazon's closed loop system. This would limit the visibility of traditional players such as banks, regulators, etc., on the movement of this value. It would also cut out several intermediaries that exist today, such as clearing and settlement systems, both domestically and internationally. Valuable payments data is actively monetized by Amazon and not incumbents to continue to expand their control over information from social intent to recommended purchases. And finally, to cover one more future state that is more about networks, consider if the movement to national real-time payments rails became interconnected globally. In this world, imagine that these rails were also readily interoperable with other non-fiat digital currency networks. This would have significant implications to today's system, such as increased speed of transfers internationally and a much improved user experience, improved system interoperability as real-time payments networks extend to other parts of the ecosystem and other kinds of currency. It would also provide access to a range of fiat and digital currencies through a growing variety of payments networks. These alternatives would likely to continue to grow in popularity across the globe and would not be limited by the confines of traditional jurisdictions or national payment systems. Now, the potential risk of increased fraud losses, including push payment fraud, money laundering, account application, and takeover fraud all exist. For incumbents, they may have to rethink their business models to be able to monetize payments data, as opportunities to make margin on payments processing comes under increased pressure. As you can see, broadening the definition of value transfer and applying our framework to think about how the different elements intersect can help us think outside of the box and prepare for the unknown. And while there are many uncertainties today, looking at the emerging trends, we do have a few hypotheses for where new profit pools will grow and previous profit pools will shrink. For instance, when we think about the new growing profit pools, data monetization is a total no-brainer. And not only for leveraging new data for profit, but also helping individuals manage their personal data, titles, IP, etc. Interoperation layers, or connecting different types and stores of value together so they can be compared, valued, and exchanged on a common basis, will be another source of profit in the future. On the flip side, there are profit pools that have existed for ages that will begin to diminish, such as traditional forms of asset custody, in a world where digital assets can self-custody. There's no doubt that financial institutions, regulators, and other ecosystem participants will need to take a hard look at the roles that they play today. And hopefully, by applying our tool for the future, they can begin to assess how to modify their position and service offering to thrive in this brave new world. And with that, I thank you all for your time, and I hope this talk has helped you imagine the future of value transfer.